Thanks very much, everybody. And I first want to thank my three speakers on the panel today. I think we have a very exciting mix of experts on the panel. So Patrick representing Principal, Nur Hisham representing EPF, and Gabriel from Fidelity International. I want to kick off our discussion today with a question to all three of you, and want you to start by telling us, giving us an overview on when your firm started this journey on incorporating environmental, social, and governance factors into the investment process, and what are some challenges that you faced so far. Maybe we'll start with Patrick, then Nur Hisham, and then Gabriel. Patrick?
Yeah, thanks, Elaine, and thanks, Busa and JP Morgan for inviting me for this session. First and foremost, I think the whole journey started about 2010 for the Principal Financial Group in the US, and we signed the UNPRI at that year. And then subsequently after that, in Malaysia itself, we started this journey, as I call it, the first phase of it in the first 2 years in 2019, late 2019. So we're close to that 2-year mark now, where we just signed UNPRI. The implications of obviously signing the UNPRI is obviously the responsibilities of carrying that pledge, right? And therefore, we started this journey in Malaysia by taking what we call a ESG 1.0. And that really means that we wanted to basically incorporate ESG principles into our investment process. What that really means is that we need to start walking the talk. And you hear me talking a lot about this because ultimately in this ESG journey is really thinking about how we want to do good, but more importantly from an investment point of view, how we want to do good for our customers as well as the in terms of the process that we go and the outcomes in terms of performance and so forth. So in that journey itself, as you can think about when it comes to ESG, obviously we think that we have always got governance in our process, but now we start to think about more on the E and the S. As you heard earlier on in some of the conversations early on from the plantation companies or aluminum companies and so forth, the challenge obviously is that we don't want to basically exclude companies. And that's basically our premise, right? And so by following a process where we don't exclude companies, we want to basically engage more at first with most of these companies, particularly, for example, in Malaysia first. And obviously, as you know, we invest in Asia as well. So ultimately, the end goal here is to engage with them and also to start the process of also engaging with some of the index providers like MSCI and some of the sustainability indices to help us screen through some of these companies. So that's the first phase. Where we are today and going to 2022 and the next couple of years is what we call ESG 2.0. What that really means is post of this engagement and the challenge that we have in engagement is that you send a questionnaire, they come back to you, everybody takes the boxes, and it becomes a tick box exercise. What we want to try to refrain from that is to move away from that and to start to think about what do we go and do more about in terms of this engagement process, right? Short of taking activism into our process itself, we want to make sure that when we say that we want to see that this company is improving in terms of its ESG journey, what does that really mean? And so we're trying to fine-tune this still, and that's what we call ESG 1.0. But ultimate goal will be to start to think about how then do we put into these different companies into the risk baskets, that we call it low risk, medium risk, and high risk, and then start to frame this in terms of the time frame or what we call a time series and figure out whether or not these companies are actually improving. For example, as you know, there are a lot of commodity companies and so forth in Malaysia and so forth, right? So ultimately, the end goal is they're doing good. How do you define what's good? Are they improving? Are they not improving? And at the end of the day, the impact of all this is, like I said earlier on, not to exclude them, but at some point, if they're not improving in this process, we may have to then basically tell the shareholders of these companies or this company itself to say that, listen, you're not improving. We may have to start thinking about reducing our exposure to these companies. So by doing that, it's an informal form of what we call shareholder activism. So that's so far what the journey is. Obviously, there are challenges there, but I'm happy to talk about that later on. Thanks.
Very interesting, Patrick. So it's Coming from the journey from 2019 when your firm signed on to UNPRI, started the path to engaging with companies, and now it sounds like you're on the path of ESG 2.0. So I got some follow-up questions, but I'll save that for later. I want to move on to give Nur Hisham a chance to share with us EPF's approach on ESG investing and how that journey has been like so far.
Okay, thank you, Elaine, and also thank you to Busa and JP Morgan for inviting me for this session. I don't think our journey has been all that much different from what Patrick was experiencing at Principal. We started with governance first. I think that was almost a little over a decade ago. We started collecting metrics on that, as well as really publishing, publicly stating what our voting guidelines are and how we will react to governance issues. We started shifting towards ethical investing, I think roughly around 2017 with the introduction of Simpanan Sharia. So there was this application of Sharia principles to our investing process. We signed on to UNPRI roughly around 2019 and launched our internal sustainable investing policy, I think later that year. And since then, what we've been doing is really developing our capability and capacity in this area. We are developing sectoral policies, we're developing issue policies. We've been engaging with our investing companies in terms of disclosure requirements as well as what their own sustainability journeys are. And this applies on a global basis because EPF has a global footprint, not just a Malaysian one. And the one thing that really stands out is that the people are at very different stages of that ESG journey. And you look at different markets, some of them are quite advanced, especially in Europe. But in emerging economies like the Philippines, Malaysia, Indonesia, it's a bit of a patchwork, I think. And like Patrick said, I think it's really more about progress rather than compliance at this moment in time. And I think our approach has been to influence and engage. We are currently going through our second round of engagement with our investing companies with regards to our disclosure, what we would like to see in terms of disclosure. But again, that is a big challenge because even in the Malaysian context, people are at different stages. There are some companies that are quite advanced, especially in the financial sector. But some companies are only just starting out and they really don't have anything to show in terms of ESG, I think, disclosures. I think the second thing is that, much like Patrick says, greenwashing is an issue. We don't want to see tick boxing exercises. It's also about what those metrics are supposed to reveal. And again, this is very much a journey rather than destination. And I suspect we'll still continue to be talking about compliance issues, whether these are the most effective metrics to look at, I think, for quite a few number of years to come. I'll leave it at that.
Thanks very much, Nur Hisham. And Gabriel?
Cheers, and thanks a lot for the opportunity. I think that we're all going to be using the word journey a lot during this session because I think that things are definitely evolving. From my perspective at Fidelity International, it really has shifted from being something that's high level and part of what we do from an informal perspective to really developing the more formal frameworks, structures, and integrated approaches that could be quantified and with very specific requirements around fund definition and approaches to sustainability. So this journey, as we say, started in 2003, where we adopted our formal principles of ownership. In 2010, we became signatories to the UK Stewardship Code, and in 2012 joined the PRI. And really where I see some of the interesting shifts and inflection points is really in the last 3 to 5 years, where there has been a shift from an informal approach and structure towards developing proprietary in-house tools to develop more structured ways of capturing ESG insight around the performance of an issuer on material E, S, and G topics. And I completely agree with the other speakers in that there is a lot of context-specific and company-specific information that needs to be collected here. And this isn't a matter of, is a company doing something? Do they have a policy? Do they get a score? Yes or no, good or bad company. It's more a case of looking beneath the data to understand how the company is progressing. Are they approaching the issues in a way that gives us comfort as an investor that they're mitigating the right risks and seizing the right opportunities and setting themselves up for long-term resilience and success? And so I think that that's the progression and path that we've been on. I was smiling to myself around the ESG 1.0 and 2.0 in that I've seen that type of evolvement of strategy of ESG scoring in a lot of places across the industry. As we get better data, as companies get more confident in reporting, it gives us more tools to enhance our own approach. And interestingly, at Fidelity, we're also going through a phase of launching our revised ESG scoring as well. So we're going through a similar sort of enhancement approach. So again, just to reiterate, it's for us definitely a journey moving from less structured to more structured and formal. And this is in response to a range of different pressures and use cases, but also in response to regulatory requirements that we're seeing in a lot of markets that are demanding this level of transparency from our products.
Yeah, so that definitely sounds like a common thread among the responses from our three speakers is the evolution of ESG integration, and even for asset manager like Fidelity having signed on to UNPRI in 2012, even the more mature asset managers on this journey is still going through the journey from an informal to a more institutionalized or structured process. I just have a follow-up question for Patrick and Hisham, because in your responses, both of you mentioned engagement with the Malaysian companies that you speak with. I wanted to see if we could delve a little bit more into that, because when investors think about the Malaysia market, it tends to be quite commodity heavy. Patrick, you mentioned about the plantation sectors. So I was curious if you could talk to us a little bit more when it comes to these commodity driven sector, or sectors that typically some ESG investors may not view as sustainable as other sectors. What's your approach in engagement aside from trying to influence them on disclosure? Are there other things that you try to influence them on in terms of long-term strategy? Maybe Hisham first and then Patrick.
Yeah, thanks, Elaine. I think we've been fairly active, I think, in engaging with the companies involved. Whenever an issue does crop up, we do try to talk to them and get an explanation. I think the key here is that for palm oil specifically, I think they are evolving as well. Obviously, with palm oil, there are more than just a couple of issues. You're talking about biodiversity, deforestation, and all that, quite apart from the forced labor issue that has cropped up over the last year or so. So I think for us, it's really about, again, you go back to an evolutionary approach. We want to see progress. We want to see them taking on the right policies, taking the right actions in terms of mitigating those risks. One thing that probably has not cropped up as much as it should is the pure physical risk from climate change to plantations. And I think that's going to be something that's going to be a bigger topic going forward. But again, this is something we need to engage with them with to make sure that they are addressing these issues. But ultimately, if there isn't any progress, if we're not seeing the right things, then action needs to be taken. You can't just talk and talk. You need to also walk it. So there has to be consequences, because otherwise all that active engagement goes for nothing. So we're at the moment we are developing our response position to particular issues, and I think you'll see some think actions from EPF going forward.
Thank you. Patrick?
Yeah, I mean, to start off with, right, like I said earlier on, we're not going to exclude them just because they aren't ESG compliant. But I think the journey for a lot of plantation companies, if I make an observations for the last 5 years or so, it's obviously improved quite substantially, right? Back in the days when I used to engage in my previous shop, right, in terms of ESG, more often than not, they will not even try to think about RSPO compliant. Today, obviously, you heard it from KLK just now, and they're always starting to talk about premiums in terms of being more green and basically selling palm oil at a higher premium just because they are getting more green, right? So I suppose I agree with Hisham as well, that essentially, in terms of the way we look at a lot of plantation companies, obviously the focus has always been on environment, governance first, and obviously environment. But I also think that the social aspects of it are sometimes overlooked as well, and something that we are starting to think about a little bit more as well. Think about the world, let's say, for example, if, for example, a bank or a financial company does not now want to then lend out to other commodity-based companies like plantation company or a coal company, for example. What are the implications, for example, from a social aspects? As you know, if you are now based out of Indonesia, for example, you have all these micro kind of plantation companies that you need to support and all the communities behind it and so forth. So hence, there isn't really an appreciation about what the real cost of being more greener really means, right? And we can talk about it a little bit later on as well. Bill Gates said basically the cost of being more green, right? And so I do think that whilst we look at this whole aspect of CPO or any other form of commodities, for example, the cost of basically complying to any form of a developed market RSPO compliant is very, very high, right? And obviously, then hence you need to think about the aspects of how it impacts social and also the environment, and at the end of the day, the cost of producing this in over the long term, because ultimately, this is a crop that as much as you want to be idealistic about being very, very green and so forth, it is a very commercially viable. It is sustaining the export market that Malaysia really relies on, and more importantly, there's a lot of people that depend on this as a livelihood, right? So something to think about as well from a social aspect.
Yeah, I think that's a very important point, Patrick, because these are sectors that do employ a lot of people, especially for certain countries. And I think the next question, I would love to hear from Gabriel from Fidelity's point of view, since you look at things from on a regional and global perspective. So because if I were a Malaysia investor, then I probably want to engage and continue to work with the companies in these sectors. But if you're a regional or global investors where you have a choice to maybe just really exclude and not invest in these companies, what is the perspective here, I guess, from Fidelity?
So I can definitely talk about Fidelity's approach, and then I'll make some broader comments around how some other international asset managers are approaching it, because there is a little bit of a difference here. From our perspective, we're actually very aligned with the other panelists' approach in that we believe that stewardship and engagement and trying to be part of a proactive and positive change at an investee company is a critical part of being a manager. The idea that having a very long divestment list or list of sectors that you won't participate in can potentially impact the cost of capital for those issuers, but it can also push them into private hands or reduce the amount of scrutiny or the transparency or ability to influence what they do. And especially if we look at some of the areas in the power generation, or whether it's plantations or other sorts of topics, by having a seat at the table, we can engage with these companies and we can see positive change. And for example, if we look at Tenaga as a great example within the Malaysian context, seeing the progression that the company has made towards decarbonisation and focusing on that pathway towards improvement, for me, is a really, really positive and encouraging shift. And so what I would say is that from our perspective, with the only time we will divest from an issuer is where we really believe that we have failed to engage successfully and that the company is not on a trajectory to improve that meets our expectations of responsible participation within that sector. We do have some very narrow global exclusions, which we just believe are inconsistent with our values. But this is more around the areas of controversial weapons and things like that. So it's not talking about commodity sectors or other sorts of areas. That said, the approach from some international managers is leaning more towards divestment and exclusion and demonstrating ESG characteristics by having a very long list of activities that you won't participate in. And for me, part of this can depend on end market demand and what you're looking for, and also the nature of the investor. But from my perspective, and also from Fidelity, speaking on behalf of Fidelity International, our approach here is really that we have to be very conscious of the social impacts and the broader context within which we're engaging with these issuers. And I think that both power generation and commodity sectors in Malaysia are a brilliant example of this, in that, yes, there can be some negative aspects, but there are a lot of positives towards the contribution that they make towards society, whether this is from employment, whether it's a cost of living and power generation and access for development and economic growth. And from our perspective, we definitely want to see movement towards better practices and towards addressing some of the negative issues of the business. But we have to be very balanced, in my personal opinion, as to how we try and drive that. So looking for change, but would prefer to have a seat at the table to drive change than to not be present.
Great. Thanks very much for that. So it sounds like the three asset managers here are quite aligned in their thinking in engaging with the companies in various subsectors. As you were speaking, I was thinking, institutional investors have a seat at the table. They can engage with the companies, but then the regulators could also play a role, because what we've seen in other jurisdictions is when the regulators step up ESG disclosure requirement, for instance, then the listed companies have no choice but to make sure that they align themselves with that. So wanted to maybe start the discussion here with Nur Hisham. If you can comment on what you think regulators can do on the ESG investing front.
I think if you look at ESG investing is investing for purpose, improvement in all those three pillars. The reality is that for a lot of institutional investors, we're only concentrated in the bigger stocks, the bigger cap issues. But if you want it to spread throughout the whole market, on the one hand, and through society at large on the other, you do need to have the regulators involved. You do need to have the government involved, because ultimately that's really what you want to see: improvement in all these three areas within each national economy. So the regulators, I think, play a key role. On our end, I think for a lot of institutional investors, for a lot of private investors, you have a level of engagement as well as influence over the larger companies, but you really want to see that propagating down into the smaller cap stocks and ultimately also into private markets as well. So the regulators would play a key role here. I think Bursa has started their sustainability reporting framework, I think in 2015, and I think we're actively engaging with them in terms of how to actually get that implemented. Bank Negara has been very active on climate change, and they also have a framework for reporting. But we'd also like to see that in a lot of other, I think, international markets as well, especially across the region where standards are again very patchy. So from our end, I think the other thing I think that will be is in terms of alignment of disclosure, because if I come in with one set of requirements and Fidelity comes in with another and Principal comes in with another, compliance costs actually go up because you're trying to cater for a wide variety of different concerns. So in that sense, I think the regulators can play a key role in terms of really defining what the minimum standards actually are, and that will be very helpful, especially for those investors who aren't quite as advanced in terms of their ESG, embedding ESG into their investment process.
Thank you. Sorry, Gabriel, I wasn't sure if you had anything else to add or.
can definitely jump in, but it was just to echo the prior comments in that, from my perspective, my favorite word here, aside from journey, is ecosystem. In that, I think that we need all players to be moving in the right direction for meaningful and lasting change. And so when I see the sorts of initiatives being done out of Malaysia, I think that the regulatory framework, I would argue, is very solid in terms of setting requirements for corporate governance, disclosure, minimum set standards, as well as the green taxonomy guidelines and other sorts of areas that have come out to help shape and guide the direction of travel from investors and issuers, I think is very, very supportive. For me, where some of the complexity lies here is around how you move from framework to implementation, and genuine implementation, avoiding a tick box approach. And so what we don't like to see as investors, or for me personally, is when people comply with regulation for the sake of compliance, not because they're actually addressing the underlying issues and challenges. Or the topics that are supposed to be addressed by the regulation. And so from my perspective, I think that there's a role to play for government, for investors, for corporates, and we can't put too much pressure on the regulators to come up with all the solutions. I think we have to be part of the ecosystem in driving the solution together. But I do think that regulators play a critical role and have been very supportive in developments of the frameworks required to take the steps forward.
Another keyword, ecosystem. So we've now touched on, a little bit about the environmental pillar. I know in your answer, Patrick, you did touch on the social pillar a little bit. I was wondering if we can expand on that, because when, we look at media news reports, there are reports of forced labor issues with certain Malaysian sectors or companies. So want to see if, Patrick, you had some comments, if you could comment on that in general, whether, are there any misconceptions or perceptions here, or how do you think companies that have been allegedly accused of certain forced labor practices can come out stronger and perhaps one day be even, to be considered by ESG investors?
Yeah, it's a very good question, right? And I do think that there is some level of different degrees of misconceptions here, right? Labor practices, yes, there are some issues in some sectors, like there was deemed to be some manufacturing companies and some glove manufacturers and so forth last year. Obviously, those have been addressed, but ultimately, I do get a sense that some of this has been provoked, for example, by some activists as well, who have probably had an agenda. But I think importantly as well, right, when we think about the social aspects on this ESG framework that we're thinking about, right, is this whole thing of how do you then price all of this, as I said earlier on, right? And to what extent are you seeing the signs in which companies are starting to improve? So you talk about in a COVID world, for example, where some of these companies obviously are obviously not taking care of some of these workers, for example. But if you start to see them changing and moving towards the right direction, then the normalization of that kind of PED rating will start to move forward. And to me, that is an alpha generator. So if you do get a sense that people are mispricing this on the E, on the S, and the G, in this case on the S, then this could be an opportunity for active fund managers like ourselves to take advantage of it and improve. So in some sense, we are all talking about the negativism sometimes about all of this ESG, but I also think about it from a positive perspective, right, whereby you can actually generate a lot more alpha thinking about companies, whether they are in sectors like utilities, manufacturing, plantation companies, and so forth, and think about, for example, what the real fundamentals are. And if it is improving, then we should be adding more position to that and adding alpha to it. So to that extent, I do think that there is a kind of a developed market sense of high watermark put into a premium to Malaysia, for example. And to a certain extent, when we talk about regulation and all that just now, right? When I was thinking about what you just said, Gabriel, just now, right? In some sense, right, Malaysia sometimes has put in such a strong framework and put itself up for such a high standard, we sometimes are a victim of our own success. Think about this, right? I mean, I was just reading through KPMG's Zero Emission Readiness Index globally. Malaysia is now the 21st in that list. And that's a fantastic journey, right? But when you put yourself up in that kind of position, you then start to be in a higher scrutiny level than the rest of the emerging markets, right? So if you think about our neighbors in ASEAN, for example, close to home, like Thailand, Indonesia, Philippines, for example, right? A lot of these countries also have a lot of commodity-based and social issues as well. None of this is highlighted at all. It is our job as investors, it's our job as regulators, it's our job as institutionals to then tell the world that we are doing a good job, but we need to uphold this. Because if not, this misconception of social issues and E or the G is going to crop up over and over again.
Where there are risks, there are opportunities. And Patrick, to echo your point, when we engage with institutional investors, we are hearing more and more that investors are looking for the ESG improvers, if you will, the overlooked old economy sectors that have perhaps low ESG scores or perception that are on the path to improvement and the market underpricing them. So I definitely think that's a trend going forward. The next question I have is I think is an interesting one, and we'd like to pose to the panel. And that is often a question we get from the companies too, is when they think that they're being asked to do more on the ESG front, on sustainability, it could hurt margins. And in reality, it really does sometimes could hurt, right? It increased costs. So from an institutional investor perspective, how should you encourage companies to balance the two in terms of managing the margins and creating a sustainable business, and also from the investor's point of view as well, right? Managing your investment returns and investing in sustainable companies. Nur Hisham, did you want to take this one first? And then maybe we can pass it over to Gabriel.
Okay. I think it's a little bit of a chicken and egg, because I think companies that adopt good ESG practices tend to do better over the long term, even if they do have to deal with that higher cost, because they're taking care of their staff, they get have higher labor productivity, because they disclose all these metrics on ESG, they will get lower cost of capital. So there's that little bit of a balancing act, I think. And it's not necessarily true that just because you're spending all this money in terms of reporting and collecting all this stuff, that you're going to suffer from lower margins. You could also, you're more likely to succeed through a crisis. You're a lot more resilient. And in that sense, I think they make for a better, I think, investment call over the long term, especially for longer term holders like ourselves. We'll be looking for companies that are, not just sustainable in terms of their practices, but also sustainable in terms of their returns. So, I tend to disagree with it's just a cost issue. It isn't. There are other factors involved. Your revenue generation should be better. Your margin should be better over the long term.
Gabriel?
For me, I definitely agree with a lot of those comments. That the way that I think about this is actually that there are a few issues here. One is time horizon. So over what period is the return for the investment on sustainability, which goes to the prior comments around short-term cost, long-term resilience. The other side of it is materiality. So what are you actually spending money on, and how are you focused? And for me, there are different areas here where I think that we need to be very clear about when money is being spent on ESG initiatives that are aligned with value creation, or when it moves into values. And so, for example, supporting a local community and paying your employees more can be one way of attracting and retaining the best talent. But if you keep paying your employees 50% more every year, you'll very quickly run out of cash to pay other parts of the business and stakeholders, and your business will go bankrupt. So there's clearly, that's an extreme example, but clearly what I'm trying to highlight here is that the tension between stakeholders, I think, is critical, and making sure that we're not just taking short-term profit maximizing decisions over a 1 quarter time frame, that we're looking at over the multiple year horizon. Are we spending capital on things that are going to have a good return through energy efficiency, through resource efficiency, through attracting and retaining talent? In which direction is regulation moving? Are we actually de-risking the business by investing in specific initiatives and operations that will put us in a favourable position to minimise policy risk? All of these sorts of things, for me, are great examples of how spend on ESG can actually have a very return on investment. There was an amusing concept from a Japanese CFO, which was called return on ESG. He was essentially saying that should be put into all finance textbooks as one way of thinking about deploying capital. But again, I personally think that yes, there can be a trade-off. There doesn't always have to be a trade-off, but we need to think about time horizon, we need to think about materiality, and then we also need to think about proportionality and the tension between different stakeholders to ensure that, that we're coming up with an outcome which takes into account a broader view of value creation.
I think that the term that you mentioned, tension among the stakeholders, is very interesting, Gabriel, because if we were to stand in the shoes of a corporate management team, they are faced with a lot of requests and tensions among, whether it be internally from the employees to externally to the customers to the investors that are engaging with them on the ESG issues. And on the line, I think a lot of the people in the audience today are probably management of listed companies. So if Patrick, if you had some advice for some of the senior manager of publicly listed companies on when they engage with institutional investors on ESG, what would be some of your tips and advice?
I don't think I'm in a position to give them any advice, because I think most of these corporates are quite savvy in terms of how they want to maneuver toward this whole ESG phenomenon we're seeing, right? I do want to make some observations though, right? And these observations are from experience, from engaging with a lot of these companies. And I do think that in our process of engagement process, I do think that a lot of companies out there think that just because they're answering our questionnaires and getting back to us, they already meet the criteria of being ESG enabled. I don't think that is. I think that's a prerequisite of the whole process, right? The second point is that it does not make any sense just because you are part of an index or an ESG index that you're also ESG enabled. I think that is greenwashing to me, right? And I do think that if we start to move along the lines of this kind of phenomenon of thinking about just because we're ticking boxes and we are part of an index, therefore we are compliant on the ESG front. I do believe that the whole ESG journey is all about a mindful, purposeful way of thinking about your business. Like Noisham has mentioned, it is a balance between profitability and the cost of sustainability. And I don't think that you can mix all of this and engineer an ESG journey overnight. It is a journey that will take some time. And my last comment is that, from my observation as well, is that, ultimately the end goal is to do good, right? And the end goal is to make sure that we save the environment, reduce carbon emissions by a certain amount, whether it's going to be 2030 or 2050. God knows whether we were going to achieve it. But my only tip is that, I do hope that when we say what we do, we have a plan and we execute it to the T and become as transparent as we can on engaging with stakeholders like ourselves to make sure that those plans are going to be executed as much as possible. And if you can't execute it, just be transparent and say you can't, because ultimately, let's say, for example, you're a utility company in Malaysia, I don't mention names, and you think that you want to increase your renewables from 17% to 32% by 2035 or 2030 or whatever, right? If you can't do it within a couple of years, you need to be transparent and say, these are the assets that are going to cost us a lot of money to buy, and therefore we can't achieve it. We may have to find alternatives. But if you're going to hide under the hood and say, I'm going to achieve this, but I'm not going to be able to execute it, then obviously investors like ourselves are going to get more impatient and more skeptical about the journey. And hence, when you put a doubt into people's minds, then people will start questioning whether this journey is real or is it just really greenwashing. And so I think the balance is real, right? So my conclusion to this is be transparent, be forthright about what you intend to do, and basically tell the world that what you can and can't do from a practical point of view, because it is really a journey, as we said, right?
Thanks very much for that, Patrick. In the next part of the last couple of questions that I have, I want to move on to, the product or the execution point of view from the asset manager and the asset owner on ESG investing. If we could start with Nurhisham, as an asset owner, so EPF manages its own money, but then it also engages with other asset managers on managing funds. So I was wondering if you can comment a little bit about what sort of criteria or things does EPF look at when it chooses asset managers on this ESG journey?
Okay, we do have a set of criteria that we applied before in terms of who we select as asset managers. There's certain things that they need to be able to do in terms of capacity and things like that. In terms of the ESG, however, I think we're still in early days. We're only just starting engaging with our external asset managers in terms of their ESG practices. But that's in the public markets. I think in the private markets, it's a bit private asset managers have actually already well along, I think, in their ESG journeys. But again, like I said, it's still early days. I think again we're still taking those steps. The destination is still a bit far off, I would think.
Okay, great. And Patrick and Gabriel, just curious, in terms of investments or funds, how does Principal and Fidelity execute on investing? Is it mostly via thematic investing or just ESG integration in your existing funds? Maybe
Gabriel,
Patrick first.
I've been talking a lot, so maybe over to Gabriel, please.
Sure thing. So for us at Fidelity International, we've got a few different approaches to this. We have an overarching framework of how we consider sustainability integration and ESG integration, and there are some different levels at which this occurs. So one of the first levels is awareness and monitoring. And so basically what that means in reality is that the funds receive the ESG information about a company and it gets considered as part of fundamental decision making. So this is basically ESG integration. More information equals better outcomes is generally the principle behind it. The next step up from that is looking at some of our funds that are for specific regulation and requirements coming out of Europe. So the SFDR Article 8 funds, for those who are aware of it, is essentially a framework for disclosure and requirements around the sustainability characteristics of a product. And so we have a minimum set of requirements for a fund to be considered as part of that range. The next step up on the ladder from there is our sustainable fund family of funds, which are essentially an ESG best-in-class strategy. And so we have enhanced exclusions that require for those companies, as well as minimum requirements on the ESG characteristics of companies that can go into it. And then we have a range of thematic funds as well. So a full spectrum ranging from ESG integration in a fundamental sense, which covers a vast amount of our assets, towards more ESG specific and targeted approaches, which are currently anywhere between 30 to 35 or 40% of assets, depending on how you cut the data. So there are, again, just highlighting that there is a bit of a progressive scale about how we consider ESG, and it's about the objective of the fund and making sure that we have the right frameworks and governance structures in place to ensure that when we label something as being sustainable, we're very confident in the characteristics of the process and outcome.
So I suppose from principal's point of view here is that obviously we have our core funds, which are obviously now we're moving towards trying to rate them on the ESG angle. Aside from the marketing angle from this, essentially we want to be able to see whether or not most of the companies that we invest in are in line with our principles of the UNPRI as well as our ESG integration. The second part, which I'm a bit more excited about now, is obviously the whole plethora of funds that we intend to launch over the coming months or years. We just launched a global ESG fund, and the appetite for that has been very encouraging. And it gives me a sense that I think from a retail perspective, not just on the institutional perspective, but also in the retail perspective, there is a gradual move towards sustainability. And that's basically from I think a point of view where I think in the dinner tables these days, or in and the conversations that we have with our children today, a lot of talk is now talking about sustainability. When I have a dinner with my children, for example, we talk a lot about the environment and the social aspects of what's really going on in the world, and hence that gets is translated to their views about how they want to invest for their future, right? And so that comes on board, and I suspect that gets a highlight, for example, through the high net worth businesses that we have, through our partners, and also to a certain extent also to the premier banking and certain retail segments that we talked about. So I do think that the advent of sustainability or ESG funds is not just at a stakeholder level like ourselves, but also from the distribution point of view, which I think people are starting to think about longer term, about where they invest, how much of these funds are going to be more sustainable, and therefore how you impact. And so I think in line with this, there is a sense of a purposeful sense of investments to their portfolios. So it's a very encouraging sign, and hopefully in the months to come or weeks to come, you'll hear a lot more from Principal on this front.
That's great to hear. We do have a question coming in asking about ESG ratings. ESG ratings is currently something that I think publicly listed companies do look at, they pay attention to, because they realize that some investors do look at them. But wanted to ask the panelists on how your respective companies consider ESG ratings, if at all. Maybe start with Nur Hisham.
Okay, we do pay attention to it, but I wouldn't say that it's the deal breaker for any in the investment process, because you do have to look at materiality, and different factors affect different sectors differently. I think plantations, you've got the environmental pillar, you've got the social pillar. I think if you're looking at utilities, it will be just the environmental pillar. Again, especially when we break down those pillars into the specific issues involved under the environment, under the social, and under governance, I don't think it's reasonable to compile all that into just one score and anchor your investment decisions on that score. It's still, I think, very subjective process. You do have to look at materiality. You do have to look at whether those companies are on the right trajectory. You can accept a lower ESG score if the management is saying and doing the right things, right? And you have an end goal in sight where by 5 years from now, 10 years from now, okay, we're going to be there. So you don't want to exclude investments like that just based on the score alone. On the other hand, if you have somebody with a reasonable score but they're not actually doing anything, again, you have to make a judgment call on that. So I don't think there's a mechanical relationship between the ESG score versus what the potential actually is. So I'll end there.
Thank you. Gabriel, does Fidelity use ESG ratings at all as a screening?
We do use ESG ratings, but we use our own ESG ratings. So we have a proprietary ESG scoring system that we've developed, which we use for evaluating the ESG characteristics of an issuer. For me, I actually think that a lot of the insight is actually not from the headline rating, but from the individual components that lead into that rating. And one of the elements that differentiate our own internal scoring versus something that you might see from a data provider in the market is that it's generated by the same analyst that as the person who's responsible for the fundamental research and buy and sell recommendations internally on that company. So what that means is they're an expert in the sector. It's done in consultation with the sustainability team who help with the framework and develop the framework in partnership. But what it means is that there's a lot of qualitative analysis here. It's not just relying on company disclosure and one or two numbers that you can get from an annual report. It really is based on our view as to whether the company's sustainability credentials are going to be value creating or value destroying over our investment horizon. And so from my perspective, that's a slightly different question than what is typically incorporated within a third-party ESG rating. I would say that ESG ratings are important in that people do look at them, but they're not the answer. They're the beginning of the conversation.
Patrick, we actually have a question that came in for you from the audience asking, how can companies be held accountable for long-term ESG targets into 2050 when management of these companies probably won't be around by then?
Yeah, that would cross my mind before in certain companies that we invest in, right? And I suppose back to the whole adage of what is material and what is achievable in the short term, as I mentioned early on, right? I do think that as much as we want to think about a long-term sustainable milestone that we talk about, whether it's going to be zero emissions by 2050 or a certain amount of emissions being reduced by 2030, for example, I think we need to think about, for example, what the journey is within the next 3 to 5 years and start to record that trend. So in principle itself, back to that question about, whether we use rating agencies and all, we do that. But at the end of the day, the materiality of using that score is really about finding out whether or not the trends in terms of the risk of not achieving it's how high versus the trends in which they are going to achieve those goals, right? So I do think that corporates, when they say what they say, and in terms of, talking about renewables or talking about, the social aspects of their businesses and so forth, that they set themselves a yearly target, for example, or maybe they're trying to explain that in their annual report, for example. But more importantly, I also think that, we really need to think about what those goalposts are, right? I mean, I don't really have an answer, to be honest, right? But I do think that if you are realistic about those goalposts, I think it will be a good sense of the direction that we're heading. Instead of putting a grand kind of 20-year goalpost, for example, which you and I may not be around by then, right? And I agree with the question, right? That 2050 is a long, long way, right? But if you start talking about a long-term trend, putting into a milestones of 3 to 5 year kind of goalposts, I think it will make more sense than thinking about a 20-year goalpost, really.
Great. Well, we're getting to the end of our session. I want to thank all our three panelists again, and wrap up a little bit. I mean, I've heard a lot of interesting things during this panel. I just like to summarize some of them. So first of all, I think there's this common thread among the three representatives of the asset management companies and asset owners is that there is no hard exclusion on a lot of these sectors in Malaysia, that the methodology that our panelists prefer to engage in is engagement with companies, to have a seat at a table to try to get the changes through. Another thing that we heard a lot about is the journey, the ESG journey, that things are evolving. And then this ecosystem, which involves stakeholders, which involves regulators, investors, etc., have a stake at the table, and then they can all play a part. Another thing that I heard our panelists talk about a lot too materiality, whether it be thinking about from the corporate's perspective, the things that they should focus on. Because if they spend too much resources on any given area, it could have an impact on cost. But in the long run, if they're clear about their plan, about the issues that are material to the company, and then execute accordingly, then the near-term higher cost that they put into on this ESG journey should result in lower cost of capital and a longer-term sustainable business. So I found all of those points very insightful and interesting. And I do want to thank all our panelists again today for joining this session. I hope everybody in the audience found this as useful as I did. And I wish everybody a good rest of the day ahead, and do stay tuned for the other sessions.